In this video, I'm going to start the discussion of the flexible budget using exercise 1634 as an example. So we have a company that manufactures and sells a preservative. The master budget calls for the company to manufacture and sell 100,000 liters. So that was our original plan of what we thought we were going to sell. At the end of the year, I'm going to skip a lot of this middle stuff for now. At the end of the year, the cost analysts report that the sales activity variance for the year was $270,000 unfavorable. So, similar to its name, a sales activity variance is driven by the difference in sales activity compared to what we expected. So, we thought we were going to sell 100,000. Because this is not zero, we obviously didn't sell 100,000, and because it's unfavorable, we must have sold something less than 100,000. Now, bear with me because what I'm pulling up here is actually the profit variance analysis that you'll see in exercise 1635. But there's two reasons why I'm doing this. One, the same flexible budget that we're going to enter in exercise 1634 is also going to be entered in 1635. You see this column right here. And also this is going to help explain part of the problem. So bear with me as far as that. Ultimately, a sales activity variance is the difference between the flexible budget and the master budget. And if you recall, the master budget, like we covered in chapter 13, is based upon our planned level activity. Here, that would have been 100,000 liters. Our flexible budget is instead based upon what's the actual amount of liters that we sold. Again, that's going to be something less than 100,000. So, for example, for sales revenue, if I'm trying to calculate the sales activity variance for it, I would figure out what was the master budget sales revenue, 100,000 times a $75 selling price, the flexible budget for sales revenue, and that would have been the same $75 selling price times whatever was the actual number of liters I sold, and that would be the sales activity variance for sales revenue. For direct materials, again, master budget is 100,000 liters times $8 in direct material costs. That's 2 pounds of material at $4 per each. And for the flexible budget, that same $8 per unit, again, not times 100,000, but times the actual activity level. One thing that I think is especially tricky is often students look at this and say sales activity variance. Well, that must just be the difference between the master budget and flexible budget for only sales revenue. And I think they could have written this problem a little bit more clearly. What they were trying to say is, no, this $270,000 unfavorable is the total operating profit sales activity variance. So the difference between the master budget for operating profits and the flexible budget for operating profits. Overall total difference. So I think that becomes very tricky. Now let's consider which items between master and flexible budget would we expect to differ and which wouldn't we? Absolutely sales. We showed same selling price is $75, but we're going to vary the activity level. Similar for any of the variable costs. Yep, for direct materials, I'm going to consistently use the $8 per unit. But again, master, the original plan, 100,000, flexible, whatever the actual activity level is. Similar for direct labor, variable overhead, and obviously contribution margin is going to be similarly affected by the sales revenue and all the variable costs. But what about fixed costs? Do we expect those to change between master budget and flexible budget? Think back to that concept of fixed costs. Absolutely not. Fixed costs we shouldn't anticipate changing just because of an activity level change within the relevant range. So all of the sales activity variances for any fixed costs, manufacturing and non-manufacturing in total, should be zero. The reason why I point that out is our overall total sales activity variance for operating profits, because there's no impact by the fixed cost, would also be the same sales activity variance for contribution margin, because again, there's no effect from the fixed cost. Now, you may be asking, that's a neat fact, but what are you telling me this? Well, if I know that the total sales activity variance for contribution margin is $270,000, If I can divide that by the contribution margin per unit, I can figure out the unit of sales difference between the plan and actual activity. So now I'm on the right trail. Again, bear with me as I go through here. So let's jump into calculating contribution margin per unit. My overall selling price is $75 per unit. Recall, contribution margin is sales minus any variable costs. Those variable costs would include my $8 of direct material, because it takes 2 pounds at $4 each. It would include my $12 of direct labor, a half an hour at $24 per hour, and it would also include any variable overhead. Now, one thing that I find here that goes wrong is a lot of times students will say, oh, the variable overhead rate is $20 per direct labor hour, so I'm just going to subtract the $20. Remember, it's per direct labor hour, and each unit only needs a half an hour or 0.5 labor hours, so I need to take that $20 per hour times 0.5, only $10 in variable overhead. If there had been any variable selling administrative costs, I also would need to subtract those here, but they didn't want to try to make this problem too complicated. So 75 minus 8 minus 12 minus 10, so subtracting all the variable costs, is $45 in contribution margin per unit. Again, we're only a couple steps away. I'm getting there. So again, total contribution margin sales activity variance would have also been $270,000. If we divide that by the contribution margin per unit of $45, we've now finally keyed into the activity difference between the master budget of 100,000 and what the actual activity level is, and that's 6,000 liters. Because of the fact that we're talking about an unfavorable sales activity variance, our actual activity must have been less than the original plan. So we'll take the 100,000 minus the 6,000 liters, and our actual activity that we need to use for a flexible budget must be 94,000 liters. If our total sales activity variance had been favorable, we would have needed to add that quantity onto original plan because we sold more than we anticipated. Again, actual sales activity volume that I'm going to use for the flexible budget is 94,000 liters. That's what I need to use for my flexible budget. Now I'm going to stop this video here and then pick up the rest of the flexible budget in the next video that covers 1635.